Hello there, my name is Lee Schertzer of Stewardship Advisors here in Mount Joy. I'm here today with Mark Brinzer, and we are starting a new series called Ask the Advisor.
The goal of this video series was just to answer some questions that we've been getting from clients. Oftentimes there's the old adage, right? If somebody's thinking it or somebody's asking it, there's a lot more that are doing the same. So we thought this would be a good chance to answer some of those questions. If you have a question you'd like answered in the post below, you can actually submit a question, as well as if you look at the monthly newsletter that comes out, there'll be a link in there. So if you have a question that you want answered, you can put it in one of those two places. So for the first question, we're going to just be talking about this idea around, is there something besides stocks and bonds to invest in? And we've been getting that question a lot, probably because of the volatility in the markets. So we want to address that today. So Lee, what else is there besides stocks and bonds that if people are interested in exploring, they could?
Yes, we are like to introduce the concept of alternative investments. And so what are alternatives? Well, as Mark said, it is an alternative to the traditional stock and bond investments that most people have experienced. This would be anything from real estate, which would be things like maybe KKR or CBRE, private equity like Apollo, and even a local company like Noble Investments. It could be commodities and hedge funds. A lot of people have heard these items like hedge funds and private equity talked about a lot in the news and in today's world. So these would be things that traditionally have only been available to the multi-million-dollar net worth people. So Mark, what are other characteristics of alternative investments?
Yeah, so there's really some things that you really want to keep in mind when you start talking about alternatives. And probably the biggest one and the most important one to keep in the back of your mind is these investments tend to be very illiquid. So these aren't something that you can get into and out of on a daily basis, right? I mean, we're all accustomed to stocks, or ETFs where you can buy and sell them on an exchange. There's generally no public exchange for these investments. So it's going to be really key that if you do explore these a little bit more, and we'll talk about this more in other blog posts, but because it's so illiquid, this should really just be probably for a smaller part of your portfolio. So that's one key differentiator. The other one is, as Lee kind of mentioned a little bit earlier, is these are usually for what's called accredited investors. Accredited investors have to meet certain net worth and income requirements. So again, this isn't something that's maybe widely available. You do have to meet some requirements. And then finally, I would say too is, they're also a lot more complex, and so their returns are driven by different strategies. And so it's really important that you understand exactly the type of strategy that the fund is going to be using, because it is going to be very different than what we normally have seen in the past in the kind of the traditional world of stocks and bonds. So, but with that, that also means there's some some opportunities there as well. So Lee, what are some of the kind of I guess I would say the benefits or the drawbacks to these types of investments?
Yes, it's important that you do consider these. So let's first of all, obviously, talk about the benefits. The first is that you can reduce the risk of your portfolio by diversifying in different types of assets than traditional assets. Studies have been done on this over and over again, and it shows that the more diversification you have, you can actually reduce the risk. The other thing is that you can enhance returns of your portfolio by adding different types of investment choices that might not be traditional, can really help in that area. Now, it does come with some drawbacks, and those drawbacks are, they're expensive. Okay, they're more expensive than your traditional ETFs and that kind of thing as far as having a manager, but good managers cost money. So it's not just expensive just because they're expensive, but they're expensive because we're buying higher quality. Also, the reason you need that higher quality manager is because these instruments are very complex. Okay, so we want to make sure that we have good managers working at really getting the best out of what they have to offer. So, Mark, what would be some final points on this introductory video that you would want to make sure we talk about?
Yeah, I think as we look at these, the biggest thing is there's going to need to be some more research and due diligence done on these. And so what we were hoping to do with this video today was just introduce the idea, as Lee said. But we're going to be following up over the course of the next couple of weeks with some more maybe deep dives on specific types of alternative investments. And we're going to cover things like, what is their strategy? What are some things to look for? And how does it fit into your overall portfolio, or if it even should fit into your overall portfolio? So there's going to be some specifics coming out, so keep an eye out as you look for more of those over the next couple of weeks. But overall, we hope that this was helpful as you just kind of get to learn a little bit more about these types of investments. And like I said, stay tuned for more blog posts with some more details on them.
Exciting times.
Thank you.